Quick question. What's your actual return on your investments right now today? Not the number the app shows you. Not roughly 12 to 13%, I think. The real number. If you had to say it out loud with confidence, could you? Most investors can't. And that's a problem. Because you can't tell if your money is working for you if you don't actually know what it's earning. Here's what most people do instead. They glance at their portfolio app, see a return percentage next to each fund, and assume that's their return. It feels like enough information. But that number is usually the fund's point-to-point return. Say, the return if you'd invested one lump sum on day one and never touched it since. Almost nobody actually invests that way. You added money in March, some more in July, maybe SIP running since last year. Maybe you pulled some out for an emergency in between. The fund's headline return doesn't know any of that happened, but your real return absolutely depends on it. Let's break down why this gap exists and what actually closes it. First, why fund return and your return are two different numbers. A fund's published return assumes a single starting point and a single ending point. But real investing is messy. Multiple purchases, at different prices, on different dates, sometimes withdrawals mixed in too. Two investors in the exact same fund can have completely different real returns, purely because of when they put money in and took it out. So the fund's return tells you how the fund performed. It doesn't tell you how you performed. Second, what actually measures your real return? This is where a term called XIRR comes in. XIRR, Extended Internal Rate of Return, is the actual annualized return on a series of irregular cash flows, deposits and withdrawals, used to measure a real investor's real returns rather than a fund's headline return. In plain terms, it takes every rupee you put in, every rupee you took out, and the exact dates each of those happened, and works backward to tell you the single annualized growth rate that explains your actual outcome. It's not an estimate or an approximation, it's arithmetic on your own transaction history. Which means two people holding identical funds can have noticeably different XIRRs, and both numbers would be completely accurate. Third, how you'd actually go about finding this number. You need your consolidated transaction history, every purchase, every redemption, across your holdings, with dates and amounts. From there, calculating XIRR is a matter of applying the formula to that cash flow series. Most spreadsheet tools have a built-in function for it, or an advisor can run it for you if you hand over the statement. The point isn't the mechanics of the calculation, it's that the input has to be your actual transaction record, not a snapshot of current fund returns. Skip that step, and you're back to guessing. Fourth, why the number is only useful once you compare it to something. Knowing your XIRR is 9% doesn't tell you much in isolation. Is 9% good? It depends what the alternative would have been. That's why the real value of this exercise is comparative. How does your actual XIRR stack up against a relevant benchmark, or against what a disciplined, rule-based process would have delivered over the same period with the same cash flow pattern? That comparison is what turns a number into a decision. It either tells you your approach is working, or it tells you there's a gap worth understanding. Say two investors both hold the same fund. The fund's 3-year point-to-point return, historically, was 15% per annum. Investor A put in one lump sum on day one. Investor B invested gradually, some in a strong month, some right before a weak patch. When you actually run the XIRR on their real transaction dates, Investor A's number might land close to that 15%. Investor B's could come out meaningfully lower, or in a different market pattern, higher, purely because of when the money went in. Illustrative figure, past performance is not indicative of future results. Same fund, same 3 years, two different real outcomes. That's the whole point. The fund's return and your return are not automatically the same thing. The number that matters isn't what your fund earned, it's what you earned, based on when your money actually moved. If you've never calculated your own XIRR, that's the first honest data point worth getting before you decide whether anything about your portfolio needs to change. If you're curious what your actual XIRR looks like once you run the real numbers, and how it compares to what a structured process would have delivered over the same period, that's something worth exploring with your own transaction history. The link is below if you'd like to see how that comparison works. That's it for this one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.